Good afternoon, everyone. Welcome to today's Wednesday market review. My name is stockdarts. As usual, you can always find me on Twitter at stockdarts. You can find me at YouTube if you search for stockdarts, or you can go visit me at patreon.com/stockdarts, where I post semi-daily blog content. Typically, I put watch list ideas and trades or potential trades that I'm looking at taking, as well as reposting the recordings of these Wednesday market reviews. We're going to do the usual. We're going to go ahead and take a look at the four major markets. We're going to look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we finish with that, we will take a look at commodities and the U.S. dollar, see how they're faring, gold, silver, oil, and then we'll move on to the chart requests. If anyone in here has a chart request, or maybe it's not even a request of a particular chart, maybe it's just a question on a pattern, anything of that nature, feel free to put it into the chat box, and I will get to them as soon as we go ahead and cover all the market stuff. Welcome everyone that's in here. I know it's been kind of interesting switching to a new platform after leaving the webinar, the GoToWebinar system, but hopefully in the future this works out better. I know that there've been some issues with questions being put in. I think you have to be logged in as a member of Ticker.tv. If you find that I'm not answering your question, it's probably because the question's not even popping up. But if you ever have a question and it doesn't get answered on these streams, just ask me on Twitter or visit us on the Discord chat and ask me on Discord, and I'm more than happy to help anyone that's looking to figure out anything that has to do with trading. It's always about helping you guys improve as traders and become as successful as you can be. But let's go ahead and get started. Let's take a look at the S&P 500, looking at the ETF SPY. We are in the middle of earnings season. I've mentioned this the last couple of weeks as we started to head into it, and we're now right smack in the middle of one of the more important weeks. We've got Facebook reporting today in the afternoon, and tomorrow we have Amazon and Google. We have Apple reporting in probably about another week. I think it's on the 30th. And so a lot of the major names will be through in the next week or two, and that should finally give us an impetus as to whether this earnings season is going to impact the markets or not. So far, really hasn't done anything. Netflix had a kind of a poor report. We had some poor reports today in the morning and yesterday afternoon with some of the Dow Jones names, which we'll take a look at when we reach the DIA portion of this. But overall, the earnings haven't impacted the market at all. We've been kind of consolidating and holding our ground and kind of staying around the same area for the last week and a half. Last Wednesday when we met, we were forming this ascending wedge, and while I considered it a short-term bearish play, or a short-term bearish move, overall in the long term this is still pretty bullish, because all that we're doing, and those of you that are regulars have seen this already, but all that we're doing is really holding and confirming price action above the previous price range, which is actually very bullish. So unless things change drastically here, unless we have a really poor report from Facebook, from Amazon, from Google, maybe more news comes out, they're being investigated more seriously by the SEC or the Federal Trade Commission, maybe there's going to be an issue then. But until then, we're doing pretty good, right? And as long as we hold above this key area, which I mentioned last week, this 291, 292 area, I think overall things are looking pretty bullish in the markets, and we're looking like we want to ramp up and continue to climb higher. Now, that being said, in the short term, we did have a bearish break from this rising wedge, which was typically what you'd expect. However, it's been pretty short-lived at the moment now. The pattern that we're seeing right now on the S&P 500 can be characterized as bullish or bearish depending on how you want to interpret this. If you look at it, we fell below the wedge, which is kind of short-term bearish, right? Because we lost the momentum as it was slowly, we were slowly losing momentum, and then we finally had that break, showing that more sellers have finally come in and have sort of taken control of the price action in the short term. Now, the bullish interpretation of this would be that yes, but it was a one-day drop or two-day drop, and we've kind of made our way right back up and are ready to start climbing higher. And this could almost be construed as a minor bull flag if you just take a look at what's happening in this little zone, right? So what we had was we had to move up, and now we're just consolidating sideways and printing a bull flag ready to move higher, right? Now the bearish interpretation of this would be that we had a breakdown from a rising wedge, and we're coming up and retesting, and ultimately coming up into resistance right around where we sort of lost our momentum in the last couple of days, right? So in order for the bearish point of view to sort of win out, we need to fail off of today's candle and come right back down and start to lose this 296 area. Now, I personally am leaning more towards the bullish interpretation of this. The breakdown was really around 298, and we're kind of right back above it, and we're starting to climb our way back up through that. So I think overall things are looking pretty solid. If you even take a look at it from this respect, give me 1 second. Alright, so looking at it from this perspective, if we can move this a bit, you could say that we've already started to climb back up after our little short-term retracement, right? So I think a lot is open up to interpretation. I think that's one of the keys right now, is that we're really in a holding pattern right now, waiting for some of these bigger reports to come through. I think once we see what Facebook has to say, when Amazon and Google report tomorrow, I think we'll have a little bit of a better picture as to where we're going to move next. I think it's going to be up. I think we're going to continue to rally. But for the moment, we're still kind of stuck in this holding pattern while we wait for some of these bigger reports to come through and give us a better idea or inclination of where the market wants to move next. Now, as you can see, obviously, there's a lot of different ways of interpreting this. But I personally feel like we're still holding strong, and regardless of what happens in this little area here, right? Regardless of whether you want to look at this as a bull flag, or you want to look at this as sort of a retest of a breakdown from a channel, all of this is occurring in a very small and very tight range, and it's well above the key point, which is what's critical here, is that we're still holding well above this 291 to 292 area. As long as we're holding above that, we're in new territory. We're still right below all-time highs. We're above the range that we spent the last couple of years in, and really the bulls are in control in anything but the shortest of time frames, right? So despite the fact that we're having a hard time really figuring out exactly where we are in the short term, in the intermediate to long term, everything is still very bullish. So I think things are still setting up, and I think they're setting up well for a nice move higher. Once we kind of consolidate and confirm that the price action considers this now to be a good value. And I went over this idea last week, but just to kind of reiterate, we're going to go back to the weekly chart. And the point is, over the last couple of years, the value point, the spot where everyone considered the S&P 500 to be at a discount, was this 255 on SPY, right? That was the bottom of the range. That was where you would consider SPY to be a good value. It was a poor value. It was overpriced once we would hit about 291. And the change in character now is that we're holding above that. So what we want to see now is that buyers consider 291 to 292 to be the value spot now, not overpriced anymore, but they consider that to be the discount and the lowest price they think they can get on a move back down, right? So if that's to occur, then we would hold above this price point, and that would indicate that the market is ready to start moving higher. Now, are we ready to continue moving much or significantly higher? I think that's still up for debate. I think that's a situation that still needs a little bit more consolidation around these ranges, particularly when you look at some of these other market indices and see how they're behaving. But as far as the S&P 500 is concerned, I think that we are, again, doing something very similar to what we did back in 2016, 2017, for those of you that are regulars, which was we had this nice 2 to 3 year sideways consolidation, and then we held above it, right? We were able to break above it and hold and kind of confirm price action. And once the price action was fully confirmed, that's when we started to move higher. And that's really what we want to see now. Now, we've had a major rally off of that, right? If you look at the long-term chart, but over the last couple of years, basically 2018 and 2019, we've traded sideways and we've mimicked almost exactly what we saw from 2015 through 2017. Move up to the top, then we came down and retested, came up, retested, pushed a little bit lower, which is what happened last year at the end of the year, and then eventually came right back up, and then the last pullback was well short of the bottom of the range, right? And that's exactly what we did again. We came well short of the bottom of the range and started to go through higher. So if you want to really look at it, what we are right now is analogous to right around here on the long-term chart and what we did back in 2016. So there's a chance that we continue to sort of pull back a little bit, but as long as we maintain price action above this range, then we're in very good shape, and we're mimicking in a very similar fashion exactly what happened a few years ago. Now, does price action always mimic itself and copy exactly what happened before? No, of course not. It kind of rhymes, but it's based off of human nature and human behavior, so it often presents us with very similar patterns, and it's up to us as traders to recognize when these patterns are occurring and set up spots where we can go ahead and take advantage of that, right? So the way it's setting up right now, it could be that we start to continue to climb higher and maybe explore newer highs before we kind of come back and retest, or it could be that we start to drift down a bit and come back and retest it. But as long as we stay above 291, as long as we hold this 50 moving average as it starts to climb upwards, I think overall we're still in a very bullish spot here, despite the, I guess I don't want to say the negative implications of the press, but sort of the distrust or the disbelief that the market's ready to run higher. And really, you have to, if you're a trader at this point, you have to kind of blank all the noise out and just focus on price action and see where the price action takes you. And right now, again, I think the price action in the intermediate to long term is very bullish. I think in the short term, it's still a little undefined. But we'll see if maybe by this Friday we have a better or clear picture of what the next step is, whether it's to come back and retest 291 or whether it's to climb higher and start exploring new highs. Now, other key levels, if we were to see pronounced selling and lose 291 to 292, well, again, we've got the 50 period right below that, and more importantly, we've got this area here around 280, which is also very critical. Now, at this point, I would not really want to see us lose 290 if I'm expecting a strong rally to the upside. But if we did lose that and come back down, I think as long as we don't lose 280, I think that things are still pretty bullish in the longer term. But it would indicate that maybe in the intermediate term, we need to spend more time trading sideways and exploring that broad range that we spent the last couple of years in. So for me, this area right around 280 to 277, that's like the big line in the sand for me as far as where I would have to kind of step back and reevaluate and say maybe we're not as bullish as I thought. But ultimately in the short term, I think the big key right now is that we stay above 291, and if that's the case, then I think that we are very close to a very strong rally in the market, very similar to what we saw back in 2017 and possibly even what we saw in 2012, 2013, 2014. Now, if we take a look at the NASDAQ, you'll notice the NASDAQ is a little bit stronger than the S&P 500, but basically doing the same pattern, right? We had the rising wedge, we had the fall down below it, and then we've had to move back up. And with today's candle, it already sort of negated that potentially bearish interpretation of events, because we're right back above this two-candle pattern here where we broke down from the wedge. And we've already climbed back above it, and we're actually, are we at new all-time highs? Or we're kind of right at it. Let's see, 194.19. 194.40. So we actually printed new all-time highs on the Qs today. So overall showing some relative strength coming back into the tech sector. Now again, I think that this is going to be impacted strongly by what happens with Facebook today after market and what happens tomorrow with Amazon and Google. So I think that's really the key right now, is seeing what these big tech names do with the market. They've been struggling a bit over the last 2 or 3 months, and if we go back and take a look, the first FANG stock that reported was Netflix, and it was actually a very poor report, although it is bouncing strongly today. And I think that this was actually a nice bottoming pattern for a bounce trade, not necessarily for a total change in direction. I think that Netflix is going to struggle to break 336. And if anyone is looking at this as a bounce play, Lana, I'm not sure if you were in here. I know you had trouble last week with logging in, but if you are watching, um, I think it's going to struggle with this 336 to 340 area. And if I were trading a bounce play here, I'd look at that as my target, and I wouldn't really expect Netflix to climb past it, at least not on the first try. Now, it could change depending on how strong the market rallies here. If the rest of the tech names all report strong earnings and the market as a whole starts to rally strongly, then Netflix probably will kind of drift along with it and maybe climb back into this range. But at the moment, what I'm expecting is for this range here that it traded in, for the what used to be the floor to now be a ceiling, and for it to struggle to push past that, at least in the initial attempt, as it begins to try to fill that gap from the really poor earnings report. Now, back to the NASDAQ. So that's the first FANG name, right? And of course, by FANG, what I mean, for those of you that maybe are newer to trading, is the big major tech names that most consider to be the best bellwether of what our market is doing, which is of course Facebook, Apple, Amazon, Netflix, and Google. And depending on how those names do, typically is a good idea of what the market is doing based off of where those names are going. So we'll see whether Facebook follows suit and does poorly like Netflix, or if it has a good report and starts to push the market forward and ahead from these new highs that it's starting to explore. Now, very similar to the S&P 500, if we end up faltering here and coming back down, I think as long as we stay above 186, ultimately that's very bullish. If we fall below there, we've got the 50 period just below it, and again, I think the major line in the sand is 178. As long as we stay above that, or even a little bit below that to the 200 period moving average, this little range here, as long as we stay above that, I think in the long term, it's still holding up pretty well. But if we did fall below to 187 or so, it would again indicate that we are not ready to rally, and we are probably still stuck in that broad range that we've spent the last couple of years in. Now, some might say that we need to hold above 191 if we really want to continue rallying in the NASDAQ. And I could see that, but I think the major part of that range really was 187. So if we do lose 190, I'm not that concerned. I'd be a lot more concerned if we lost 187 to 188. And at that point, I'd say that maybe we're not ready to rally and maybe we need to trade sideways. But again, the way things are looking, it looks like we want to move up already and not even bother retesting to the downside. But that's the NASDAQ, which is doing better, of course. And at the moment, I think is the strongest of the four market indices. And of course, some of that has to do with the Dow Jones starting to slack a little bit. Now, this is still pretty bullish. Matter of fact, this I think is the clearest bull flag of any of the charts that we're watching. Right? You take a look at this, you compare what's happening here, and you can see the Dow Jones actually was, relatively speaking, strong over the last 3 weeks or so, right? The rising wedge that the other two formed, the Dow Jones broke to the upside of it. Now, the rising wedge for them was a lot shallower, right? So it was actually, relatively speaking, a little bit weaker up to that point, but then it broke out, and over the last week and a half now, it's printed a pretty solid bear flag. Now, unlike the NASDAQ, which is printing new highs, and the S&P 500, which is above yesterday's price action, the Dow Jones is a little sluggish today, and part of that is because there were a couple of big names that reported that are Dow components, right? Boeing reported and was not a terrible report, but it's down on the day. Caterpillar also down on the day, although it's kind of fluctuated pretty wildly. And United Health also reported and is bounced back pretty strongly off of the lows of the day, but overall, again, was not a strong report. And so the thing here is that we've got the Dow Jones being held back a bit today because of three reports that weren't really strong. But the key to note is that even though the three reports were not really very strong, we're really almost unchanged, right? And we're still well within this bull flag, and nothing in the bigger picture is really pointing to negative behavior. Everything here is still looking strong and looking like we are ready to rally and ready to continue moving upwards. Now, the key levels on the Dow Jones, I think, again, are very similar to what we just pointed out on the S&P 500 and the NASDAQ. And the first is, of course, we're still holding above the previous range. If we go to the weekly chart and take a look at where we've spent the last couple of years trading, you'll see it's a nice and easy to define range, right? For the most part, the ceiling is right around 266, 267, somewhere in that 267 range, and the bottom of that range is somewhere around 235. Now, of course, we did have the drop below that at the end of the last year. All of the ranges we've been looking at for these indices all had that big breakdown. But the majority of the price action was using 235 or so as a floor. We're above that. We're in the process of confirming price action to hold there. And again, it's mirroring exactly what we saw a couple of years ago when we broke past the previous range. And I can just sort of use this box, and you'll notice how similar it is. Right? A little bit shallower. But for the most part, it was the same idea. We traded at a certain range, and then we broke out above it. Now, you'll notice the Dow Jones, a little bit different. We had some price action holding above for a while, and eventually it broke above it, and then came back and retested. And then eventually, once we were able to confirm price action above here and break through it, you'll notice that was when we had a massive rally. And again, that's kind of where we are right now. You'll notice, again, the box is a little bit more narrow because we haven't spent as much time. But for the most part, we're doing something very similar. Alright, so as you can see, for the most part, if you really want to focus on the intermediate to long term, there's nothing you can really point out that's negative. And it's interesting because, again, the general consensus I get from social media and from even from TV to a certain extent is that this rally's still a little suspect and that we're still not really sure where we want to move. And again, I think a lot of traders feel like this is smoke and mirrors, but the truth is, regardless of how we're climbing, the market is climbing, and the market continues to push upwards and continues to explore new highs. And as long as it does that, we need to go ahead and take advantage of that. Now, in the short term, again, I think that we're in a spot right now where our risk reward, it's getting better. We're at highs, right? So risk reward really is not that great, but we have these consolidation ranges now that we can use to improve our risk reward when we're looking at specific setups to trade in the market, and we're looking for specific plays that we can go ahead and take advantage of, where we can manufacture better risk reward by using these bull flags as our stop out points, depending on what kind of pattern we're looking for and how we're trying to go ahead and take advantage of this upward momentum in the markets. And we'll get to that a little bit more when we get to the chart, of course. Again, if anyone is in here, I see we have quite a few participants, but I don't know how many of you are able to talk because, again, I don't know if you're registered with this site or not. But feel free to put in any charts you guys are looking at. We should have a decent amount of time today to look at them, and let me know what you're looking at and whether it's a trade that you're in and you're trying to figure out where your target should be. Maybe it's one where you're trying to figure out where you should stop out. Just let me know what it is and what you're looking for, and I'll go ahead and try to help you as much as I can when we take a look at those charts. But I think overall, again, the risk reward has improved dramatically from where it was a couple of weeks ago, but it's still not in the best place if you want to go ahead and get aggressive to the long side. But I think the way things are setting up, particularly looking at these first three market indices, it looks like we're setting up for a pretty strong rally in the overall markets. Now, of course, there is. You want to go ahead and get aggressive to the long side, but I think the way to mute myself there. Of course, there is the one caveat or the but, which is IWM. Now, IWM, very strong day today, which is nice to see. So in the short term, we're starting to see relative strength, at least for today. But overall, in the intermediate to longer term, we're still stuck in neutral here. We take a look at the weekly chart, and you can see we're nowhere near all-time highs. We're nowhere near even the middle of the range that we spent the last couple of years in, and are really just trying to hold from coming back and testing the bottom. Now, we are having a nice move today, but again, as strong as that move is, it's only now beginning to climb past what could be a pattern developing here. This sort of descending triangle in the middle of the range. You'll notice that when we were climbing, we kind of lost momentum on that already, and really, I think for me to get behind the market rallying strongly, we need to get back above 158 at the very least on IWM. This was the scene of a pretty big bearish shift in sentiment, and until we can kind of regain that battle line and get back past above it, we're still really not in a good spot with IWM and with the small caps. So I think that's one of the keys is we need to get back above that area and start to explore the upper half of that range that we spent the last couple of years in. So clearly in a much different picture, in a much different state from what we're seeing across the board with the other three indices. Now that being said, we have rallied strongly throughout the last decade, regardless of whether IWM was weak or not. You'll notice again, if we go ahead and take a look at some of these previous ranges, IWM typically has been weaker. Now this is a monthly chart, right? So that 2014, 2015 to 2016 consolidation range for IWM was a little bit different. Unlike the others, it actually did have a pretty dramatic breakdown that looked like the market, it was kind of giving us hints that the market wanted to roll over before we kind of climbed back above it. And it spent a little bit less time. Again, if we'll go to the weekly charts, so you get the same consistent picture. You'll notice that there were ups and downs with IWM, right? It actually tried to climb higher first. It eventually lost ground, and it came down and broke down below the range. And then even when we did break out, you'll notice IWM had already broken down back into the range prior to the big breakout that started that 2017 rally, which was, of course, during the elections. So IWM has often shown us weakness, right? Even when the rest of the market was rallying strongly, IWM spent a good portion of 2017 trading sideways. Again, compare that to what we saw in the NASDAQ, which was just pretty much a straight climb. A little bit of sideways action for a couple of weeks, but pretty much a straight climb. Well, not a couple of weeks, but a couple of months. And if you look at the S&P 500 again, a straight climb, right? Dow Jones, straight climb. And then again, to contrast, IWM stuck in neutral for a good portion of that, right? So it's not unheard of for us to rally without IWM, right? So the fact that we're here doesn't mean that the rest of the market can't rally. Matter of fact, we've been rallying quite steadily even without IWM participating. But I think in order for us to get a really strong rally, we want IWM to at least be participating. And in most of the times when the market climbs, IWM did climb, even if it was reluctantly, right? So I think in order for us to really get excited about a market rally, we need to see IWM at the very least get back above 159 and start to explore this vacuum above these two twin candles that look like we were ready to rally and that we lost. So I think that's the key for us. Now again, today is a good start. We have a nice little pattern here where we were able to kind of confirm 154 support after a small failure at it. And we got back above the 20-period moving average today. So the next key is to break this descending trend line that's kind of a short-term barrier, and then reach 158, and then see what happens as we reach 158. But I think overall we're still kind of struggling here, and until we see a better pattern coming out of IWM, I think that the overall market character is probably going to be one where we continue to kind of hover sideways and kind of wait for more confirmation before we can continue to rally. So that's the one mixed bag here, right? Or the one kind of mixed signal is the other three indices all look very strong. They all look like they're ready to rally higher, but we've got IWM, which is kind of slowing us down and holding us back. Now again, throughout the last 10 years or so, the markets have rallied regardless of whether IWM was ready to participate or not. So I wouldn't put too much stock into what IWM is doing right now, but I do think that we need to see more strength here if we want to see a rally that is analogous to what we saw in 2017, and more importantly what we saw like in 2012, 2013, which is when the market was really running strongly, in which, in these scenarios IWM did participate. And so that's, I think, where we stand right now with the four major markets. Overall, it's a lot more bullish than I think a lot of people want to give the market credit for being. Uh, and really, it comes down to whether we're ready to move higher or not. But I think overall, even if we're not ready to move higher over the next couple of weeks, as long as we don't lose a lot of ground, all we're really doing is biding our time and building our momentum in order to climb higher once the market's ready. Um, and for those that are worried that we're kind of at highs, and if we pull back, the first thought is going to be, well, we're about to top out. We have warning signs. We have areas. We have levels that I just pointed out across the board that'll give us the warnings we need if the market is indeed going to top out. I don't think that we're anywhere near needing to consider that. But if we lose some of those key levels that I pointed out, then we can start to discuss the idea that maybe the market is in a different state, and we can start looking at whether we need to play bearishly or not. But I think at the moment, anyone that's looking to short the market is setting themselves up for a lot of pain, because there's a lot of bullishness in here, and there's a lot of pent-up demand that is hiding beneath the surface. And I think it's pretty obvious just by taking a look again. If we go back to the S&P 500, you just take a look at what happened. We were losing momentum and climbing higher, and then eventually we had sellers kind of come in, but it was bought up immediately, right? And it was one red candle, maybe two red candles, and they were both immediately bought right back up, and price moved right back up to where it was before. And I think that's the case. Even if you do get a good short, you're going to have to fight with all these buyers that are waiting to step in and buy it immediately as soon as it drops a bit. So I think at the moment, short trading is not a good idea. Trading to the long side should be what you're focused on. And I think the idea right now is you just need to find charts that give you good risk reward. You don't want to chase price action higher. I think that's really the biggest danger at the moment, is getting caught up in the euphoria of a market moving higher and just chasing it and kind of ignoring the normal parameters that we look at when we're trying to trade. We still need good risk reward. We still need setups that are in our favor, both from a risk reward perspective and from a timing perspective. You don't want to buy something that's up 6 days in a row. There's a chance that there's more likely than not it's going to pull back, which is the normal ebb and flow of these equities, right? It's a normal part of the buy and sell process, and I think a lot of times what happens with traders is they get caught up in the moment, and they try to buy something when it's up too many days in a row, or if it's at a point where there's really no good clean stop out point, and you end up having to hold it for a while as it drops back on you. And it was a timing issue. It wasn't even that you picked a poor chart. It's just that you had bad timing when you entered the trade. So I think that's what we need to be cognizant of right now, is just making sure that we have discipline, and that we're looking at trades that give us good setups, not just looking at charts that we think are going to go up. All right, so that's the four major markets. Again, I think overall it's still pretty bullish. I think once we see what happens over the next 2 days with Facebook, Amazon, and Google, we'll have a better picture of whether we are going to start rallying strongly or whether we need to come back and retest the highs of the previous range. But I think as long as we stay above those critical levels I pointed out, overall things are still very bullish. All right, so with that being said, let's take a look at the U.S. dollar, look at oil, gold, and silver, and then, again, if we have any chart requests, feel free to put them in there. All right, so we look at the U.S. dollar. Interestingly enough, we had a strong gap up yesterday, and it's holding today. So the U.S. dollar is gaining strength, which is quite interesting because, again, we keep hearing about the Fed wanting to lower rates, and the U.S. dollar had started to lose momentum over the last couple of months. As you can see, as we started to hit into June, we started to drop, and we lost this strong channel that was holding for a while. And then now what we've done is we've kind of climbed higher, but we're printing, to a certain extent, a rising wedge. If we use the bottom of the previous channel and then this newer ascending trend line. But for the moment, the U.S. dollar continues to climb, and this was again a nice strong move over the last couple of days, which again broke through what was beginning to be some bearish sentiment. That's we started to see a little bit of a decline in momentum, and then we just had this big gap up. So overall, the U.S. dollar is picking up strength when I think a lot of traders are not expecting it. If we take a look at the euro U.S. dollar, you'll see that we lost ground on the euro, a big move down, and through a pretty critical level, this 111. Now, we're still holding on at the last line of defense here. And I think the key now is the euro going to continue breaking down? Again, there was a pretty big change in character in the euro recently as we broke past this 112 area and this bearish sentiment that had been developing. And we go ahead and take a look at the weekly chart. We can see that the euro was losing some serious ground. Again, we'll back up a bit. You can see this is an important area, this 113 to 114. We had broken through it strongly and then came back and really struggled to maintain support at that price point. And eventually price action eroded enough to have a breakdown below it. And then recently I was able to finally break past it. And for the moment, it's looking like that breakout is a failure, right? And that was based off of what we saw yesterday, which is part of the big move with the US dollar gaining some strength was the euro losing a lot of ground. Again, look at this breakout right at 112, and it held as support the last few times that we tried to break through it, and now we have this breakdown and break right back below it. So at the moment, it looks like the euro is losing ground. It will probably find some support here at 111, but once it does that, if it cannot break past this 112 area, or at the very least this 111.80, then I think that we've seen a shift in character, and the euro will probably look like it wants to start dropping again. So this was a pretty big change, and unless we see a move past this area here, I would say that at the moment that means that the euro is back in a more bearish territory and looking like it wants to drop. So overall, this is, I would say, bullish in the long term for the US dollar. And bearish for the euro. But a lot depends on how this resolves and what happens next. But this was definitely a very bearish turn of events for the euro. Now, we look at the US dollar versus the Canadian. It was a nice breakout. Again, sort of in the face of what was a bearish pattern, right? You can see that we were drifting down and printing a channel down as we were losing momentum on the US Canadian. We eventually found some support here and are now breaking out. And you'll notice even with yesterday's move that we did find some selling pressure on the US Canadian, but I think overall this is a bullish turn of events. So again, mirroring what we're seeing with the euro US dollar chart, where the US dollar has finally shed off some of that weakness and is starting to show signs of strength again, and a change in the overall direction of its chart. Now, is it ready to rally strongly? I don't think so. I think at the moment it probably needs to spend some time just kind of confirming the breakout from this channel, and we'll probably spend a while trading somewhere between the lower 130s and maybe 132 to 133. And I don't think it even gets to 133 anytime soon. But I think at the moment it's just more than anything changing from down to neutral, and we'll see where it wants to go next. And then if we look at the U.S. versus the yen, a very different picture altogether. The yen has picked up a lot of strength recently, and the US dollar has struggled to keep up with it. And while the other charts were looking like they were bearish, this one was looking more neutral, but we actually had a breakdown. Even with the US dollar gaining a lot of strength versus the euro and versus the Canadian, it actually lost strength versus the yen over the last week. And even though we've had a rally over the last couple of days, really it's at the point right now where it's just confirming a break from this descending triangle or ascending triangle. And if it cannot get back above this 108 or so, it looks like it wants to head a little bit further south. So a different picture altogether compared to the other two. I think for the US dollar to gain, to kind of have or at least a chart of the US yen to have to be in the same place as the other two charts, it needs to get back above this 108.6 or so. At which point we could say that it's broken this bearish trend completely and is ready to kind of climb higher. At the moment it's still neutral, and really it just depends on what it does next, whether it continues to climb back into this 108 or whether it loses momentum and comes back and revisits the lows. So I think we're still seeing a little bit of a mixed picture. I think the euro chart is kind of at a spot where anything goes. I think it's it lost a lot of ground, but it still has a major floor here that it can hold as support. Um, and I think with that and what we're seeing with the yen, I think that it's still kind of a mixed bag with the U.S. dollar. But I think overall the U.S. dollar is starting to show more signs of strength than maybe what we've seen over the last month or so. Now that being said, we look at gold and silver; they're still holding up pretty well. With the U.S. dollar gapping up over the last couple of days, we're of course going to see a drop in gold, but it wasn't a major drop, and it's still holding pretty steadily, and it's still holding near highs. And it's actually kind of odd. It's very rare to see the market at highs, to see the U.S. dollar at highs, and to see gold at highs. Now, that being said, gold, of course, is at short-term highs, but long-term, it's nowhere near all-time highs. But it's rare to see all of these commodities moving up together. That's not something that you normally see. So I'm interested in seeing in the end which one gives way and what happens. But for the moment, gold is looking pretty strong. Silver has actually gained a lot of strength as well. As a matter of fact, over the last week or two, it's actually been, relatively speaking, much stronger than GLD and gold, but it was playing a lot of catch up. So we'll give it the benefit of the doubt for that. But I think overall, I probably still prefer to trade GLD over SLV. I think SLV has made its run to catch up now, and we'll see what happens as it starts to consolidate this run. Now, again, if you look at what we're seeing here, we're starting to see some waning momentum. So at the moment, I don't think this is a good long in the short to intermediate term. I think we need to see this consolidate more. With the strength we're seeing out of the U.S. dollar in the short term, I think that gold and silver probably need a bit more time to consolidate. So for the moment, we're probably better off watching these than looking at a trade. I don't think there's a clean trade set up at the moment. But we'll see what happens as we progress, and once we see what happens with the U.S. dollar and the euro, and how the U.S. dollar behaves as it starts to hit these new highs on its different crosses. And the last commodity, of course, is oil. And oil's in a different place from all of these. It's still struggling. It is, at the moment, attempting to break a pretty strong downtrend. The last time it broke it, it only lasted about a day before it kind of faded, and then 3 or 4 days later it broke right back below. We did find good support at 54, which I think is a pretty strong area of support, and as you can see, we are again bouncing into resistance, and the question is, will we find enough momentum to push higher, or will we again fall back below and continue to follow the strong intermediate term trend to the downside? I think it's a messy chart right now. I don't think that there's a lot to trade here that I'd want to trade. I think trying to go long here would be difficult because there's a lot of overhead resistance. And trying to short would also be difficult because support is pretty close by. So I think at the moment, there's not much with oil that I want to trade. I think I'm just watching it. Same as gold and silver. Even though gold and silver have provided some nice long moves in the recent in the last couple of weeks, I haven't traded them because I'm not really happy with the patterns they're giving me, and I'd like to wait for a cleaner pattern before I go ahead and get involved with any of these three commodities. So that's the market review, and those are the three charts. Again, I'm not seeing any chart requests. I think that that's probably an issue with ticker.tv at the moment, but what we'll do is I'm going to show you guys a couple of the trades that we've been looking at on my Patreon page, and then from there we'll basically end it for this week. What was the? Well, let's just go to our Patreon page. All right, so yesterday I pointed out, and we'll look at it here at JD.com. You can see on the chart here it was setting up a nice consolidation off of really a nice, basically consolidation off of a previous consolidation, right? We had a nice climb up, a nice trend shift, then we had a nice channel that it formed, and then we broke out and we were printing a nice little tight channel consolidation, and it was starting to show some signs of momentum yesterday in the afternoon. So I recommended it as a trade, and as you can see, any of my Patreon members that were able to get the alert in time have had a nice move off of this. We had a nice climb higher past 31, and today it's kind of following suit and climbing a little bit higher. Now this has earnings in a few weeks, so we have a tight window on it, but the target on this is somewhere in the 34 to 35 range. And again, just to show you guys what we're looking at and what we're trying to figure out is we're trying to find trades that are giving us better consolidation and tighter setups where we can go ahead and find a better risk reward and play something that's not quite as extended as the market, but is doing something similar. And JD was doing something very similar to market, which is consolidating after kind of climbing up over the last month or so. Now another one. Another one that's doing well for us is WBS, right? So you take a look at Webster Financial, and again you can see very nice move today, very nice move over the last few days. And this was one that I posted on Monday, and the idea behind this was we want to look at names that have already reported earnings in order to avoid earnings risk, right? One of the big keys I always mention during earnings season is you want to avoid swing trading a name that is reporting earnings. Now, that doesn't mean that I like to avoid trading earnings. I love trading earnings, but there's this very specific way to trade earnings. You need to make sure that you understand your risk. And what I found with earnings is the direction of a stock is very difficult to predict, but volatility is a little bit easier to predict. So typically when I'm trading earnings, I like to trade volatility with options, but that's not for everybody. A lot of people don't like using options. A lot of people don't like trading directionless trades. Most people prefer to just trade a direction, and most people, beyond that, even just prefer trading to the long side. That being said, if you're just swing trading off of a chart and you have no idea that earnings is coming up, you could be exposed to something like Netflix, right, where you have a 10-15% drop on a name that you didn't know, that you couldn't predict or you couldn't control. So one way to avoid earnings risk is to wait for names to report earnings and then trade them after. And that's what we did with Webster Financial. They reported earnings last week. And then as you can see, they were breaking a nice trend, and we were able to get a nice consolidation as it retested this breakout and have had a nice move over the last couple of days as it's climbed higher. And this is another way of being able to control what we're doing and finding trade setups in a market that's maybe not giving us as many as we'd like. So those are two ways that I've gone ahead and tried to recommend trades for anyone that follows me on Patreon in order to combat what we've been stuck at, which is, of course, earnings season where there's less trades to take because you don't want to trade something, you don't want to hold something through earnings unless you understand the risk and are able to absorb it. And then two, finding names that are giving us better trade setups or better risk reward than what we're seeing in the overall markets. So that's just an example of what we're doing. Again, if you want more exposure to these sorts of ideas, go ahead and follow me on patreon.com/stockdarts. The basic subscription is only $8 a month. If for whatever reason you can't afford that, most of the trades become free after a few days or a week. There's a lot of free content on there anyway, and really it's kind of a win-win for you. There's really nothing. You just get better trade ideas throughout the week, regardless of whether you want to take them or not. You still learn just from watching the thought process of another trader. So hopefully that helps. And that pretty much covers it for today. Those of you that are in here, again, if you tried to ask a question that didn't come up, just ask me on Twitter, or you can ask me on Discord, and I'll be more than happy to help answer these. Okay? Other than that, hope you guys have a good rest of this week and weekend, and we'll meet again next Wednesday.